if I'm right about the monetary system and it failing, we know that, if you had been on the Titanic and the same kind of thing had happened, it wouldn't have mattered what you had to pay for the seat. You wanted the goddamn seat because the alternative was terrible. So, it's being a little bit extreme, but perhaps not too much. I mean, this monetary system really is quite broken, and you need to read the book because the book talks about the history of these kinds of things. And, it may not go all the way to the Titanic sinking. I mean, we may just have really high inflation and a monetary reset, to be fair, and to say that, but even in that case, gold and silver and Bitcoin will be an advantage to have over, all the other traditional assets.
Gold prices have surged to unprecedented levels, surpassing $3,300 per ounce as of April 16, 2025, driven by macroeconomic and geopolitical pressures. This explosive rally has ignited discussions among analysts over whether the market is entering a classic blow-off phase. This sharp, accelerated rise often signals the end of a bull run. Yet the scale and pace of this move suggest it may not be a mere speculative spike. Gold has jumped by over $1,000 in just a few months, climbing from $2,300, a move many view as a reflection of growing unease in global financial markets. With inflation remaining stubbornly high, government debt reaching unsustainable levels, and rising concerns about the credibility of central bank policy, investors are increasingly gravitating toward time-tested stores of value. According to financial strategist Lawrence Lepard, this surge is less about price speculation and more about capital preservation in a changing system. In his view, the focus is no longer on valuation metrics, but protection from currency dilution and systemic risks. Yes, gold is now $3,300, and Bitcoin may be above $85,000, Lepard noted. But the real question is whether you want exposure to something real, something that can hold value independent of policy decisions. Increasingly, investors seem willing to buy into these assets even at elevated levels, not because they expect quick gains, but because they sense traditional financial structures are becoming less dependable. The rapid accumulation of such assets signals a growing acceptance of this new logic, where tangible, decentralized, or finite value holdings are being prioritized over conventional investments tied to fiat liquidity and central banking. As the US dollar weakens and its purchasing power erodes, attention increasingly shifts toward a more diversified, multipolar financial system. Central banks have quietly been increasing their gold reserves, and analysts advocate for a return to monetary discipline rooted in hard assets. Although the dollar remains dominant in global transactions, its long-term viability as a store of value is being questioned. In response, investors and institutions are repositioning their portfolios with a growing emphasis on gold and other hard assets, recognizing their ability to preserve wealth amid the volatility and uncertainty of the current economic environment. Now, we present the clips from Lepard's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The model here is not that this price necessarily reverts to the mean. The model here is that the monetary system is changing. So a lot of people look at something on a price run like that and they say, well, that's overbought. That's a bubble. That's going to break. I don't want to buy it. I'm too late. And we see this in gold and we see it in Bitcoin. I see it particularly in the Bitcoin world. I have a lot of friends I've tried to convince on Bitcoin. They might get convinced and then they say, gee, Larry, that's great, but I got to pay 85 or 100,000. You were buying it at 5,000. And, I don't want to do that. I'm paying top price. And what I would suggest is that you turn this upside down and look at it as a slightly different thing. It's more like, the old monetary system was stable and the new monetary system is an avalanche. And we've had enough, snowflakes fall that the avalanche is broken free and it's got a ways to run. Or said another way, consider the old monetary system is the Titanic and it's being transitioned and changed to a sounder monetary system. And the lifeboat seats are represented by gold and silver and Bitcoin. And so, okay, yeah. So I bought some gold at $1,000 an ounce and I bought some Bitcoin at $5,000 a coin. And those are seats in the lifeboat. The cost to you today, you want gold, it's 3,300. You want Bitcoin, it's 85,000. Same seat as the one I bought, but it's more expensive because we're a little further down the road. So, okay, Mr. Investor, do you want to continue and hang out on the Titanic or do you want to pay more for the seat? Because I mean, if I'm right about the monetary system and it failing, we know that, if you had been on the Titanic and the same kind of thing had happened, it wouldn't have mattered what you had to pay for the seat. You wanted the goddamn seat because the alternative was terrible. So, it's being a little bit extreme, but perhaps not too much. I mean, this monetary system really is quite broken, and you need to read the book because the book talks about the history of these kinds of things. And, it may not go all the way to the Titanic sinking. I mean, we may just have really high inflation and a monetary reset, to be fair, and to say that, but even in that case, gold and silver and Bitcoin will be an advantage to have over, all the other traditional assets. The dollar is a funny thing because it's measured really in all the other fiat. I mean, all the currencies are fiat, right? There's nobody who's on a sound money standard right now. So you're measuring the euro fiat against the British fiat, against the Chinese fiat, against the American fiat. So I think the American fiat, if you look at the income statement and the balance sheet of most of those countries, I think the U.S. is just demonstrably in worse shape than all the others. But it's been the reserve currency, so it's enjoyed a premium. I think the dollar has a long way to fall. All of those currencies, I mean, what they represent is they represent currencies, things you can buy things in. Everything's priced in dollars. You can easily do a dollar price of anything, as you can with a euro. And the FX markets are very efficient, so you can move from one currency to the other. So to me, how the dollar does against the other currencies, I think it'll fall because it's overvalued compared to the other currencies. But what really matters is not that cross. What matters is the cross between the dollar and gold or the dollar and Bitcoin. I mean, I think, look, Bitcoin does not have, and gold, there are mechanisms for doing it. I just heard about one actually in Britain that was pretty cool for kind of keeping, Bitcoin in your account, or gold in your account, and then paying for things in dollars or pounds. But because switching from one to another is not hard, but most people have, currency accounts based on their local currency, and they pay for things in their local currency. And I think what will happen is kind of a mass version of Gresham's law, which says that people will, yes, you'll continue, the dollar will be around, we'll keep paying for things in dollars, but that won't be, nobody in their right mind will ever leave anything in dollars for very long because they'll know that they're melting, that they're losing value. And so to the degree you get paid or you have some savings, you'll instantly convert them into something that won't melt in value, and that's Gresham's law. The sound money, the bad money pushes out the good. People spend the money that's bad, the fiat currency, and they save in the money that's good, silver, gold, and Bitcoin. So, that to me is what's going to happen. But we're going to have a much more multipolar world, Kai, and I'm all for that. I mean, I think the U.S. has abused its privilege as the world's reserve currency. It's allowed us to conduct wars, do a lot of stuff that made no sense. So, having a more balanced regime of lots of currencies, and then with gold and perhaps Bitcoin as being the neutral reserve currencies, that'll be a better world, in my opinion.
Lawrence Lepard underscores the growing urgency surrounding the U.S. government's escalating deficits, which are becoming a major driver of the broader financial instability. With projections indicating that the deficit could surpass $2 trillion this year, the government's reliance on bond issuance to cover its debt obligations is increasing. However, this move creates an unsustainable cycle. As the supply of bonds increases without a corresponding rise in demand, interest rates must rise to attract buyers, thus raising the cost of servicing the national debt. This surge in borrowing costs leads to even higher deficits, forcing the government to issue more bonds. According to Lepard, this debt accumulation cycle is unsustainable and pushes the U.S. toward a potential sovereign debt crisis. As the dollar's value erodes due to inflation and increasing debt obligations, more investors are looking to tangible, non-fiat assets like gold and Bitcoin. Lepard points out that the Federal Reserve's actions in response to this crisis are revealing the limitations of the current monetary system. In an attempt to control inflation and address the growing debt burden, the Fed has reduced its rate of quantitative tightening, which is essentially the shrinking of its balance sheet and the withdrawal of liquidity from the market. This action comes after a significant uptick in bond yields, signaling potential instability in the bond market. In response, the Fed quickly reversed course, indicating the urgent need for intervention to prevent further damage to financial markets.
Trump is doing with the tariffs, we're seeing foreign selling. And if you think about it, if a foreigner loses money, if a foreigner owns a U.S. stock and that stock goes down 10%, well, that's painful. They lose 10%. But if the dollar goes down 10%, well, then they go to convert their dollars back to their home currency. And so now they've lost 20%. So So yes, we're seeing foreign money coming out of the U.S. stock market. And I think that trend has quite a ways to run. But more importantly, just to answer your question about, let's define the sovereign debt bubble. So, this is what I call a death cycle, or a death doom loop, and it's pretty straightforward. The U.S. federal government has 37 trillion in debt, and my book lays this out and shows you how rapidly that's grown. And then, as Powell pushed interest rates up to try and deal with the COVID inflation, interest expense has grown as well. So now the U.S. federal government spends close to $1.2 trillion a year on interest, just on the existing debt. And that's larger than the defense budget. That's a big number. And in turn, the U.S. government is running deficits, which they ran during COVID. You could explain that, as a crisis, but they kept running them post-COVID. You would have thought the spending would go down. It didn't. And so, last year's deficit was 1.8 trillion. This one's running to something over 2. And here's what happens. To cover that deficit, they have to sell bonds. They sell bonds into a bond market of a fixed size. If you come to sell more, if there's more supply of bonds and the same number of buyers, then the price of the bond, the interest rate on the bond has to go up to entice people to buy them. That interest rate going up is what the federal government then has to pay on all the existing bonds as they roll over. That then makes the 1.2 trillion of interest expense become a bigger number in the following year. That then makes the deficit become a bigger number. That then means they got to sell more bonds. And you see where I'm going here? You've got kind of a negative feedback loop that really is at the core of the problem. And in fact, it was the U.S. 10-year moving from, when they first announced the tariffs, the stock market went down and the bond market did what it traditionally did. It was a safe haven and it rallied. And that looked good. That was kind of what dissent probably wanted. But that rally didn't last very long, and pretty soon people started selling the bonds too. And I think the reason for that is people realize that the stock market going down will decrease tax revenues, will increase social payments, and the deficits will get ever larger. And so, this is a problem that it's hard. It's Lynn Alden's meme. Nothing stops this train. It's very hard to reverse this cycle that we're in. And that's what's really leading to the sovereign debt crisis. And so, where it ends, we don't know. We can map out a lot of possibilities. The book does that. I give you a lot of scenarios, but it certainly doesn't end in less inflation. I'll say that with a high level of confidence. So he's really trapped. He really is. He should have resigned a long time ago. I wouldn't want his job.
For $180,000 a year, you got all the headache, right?
Yeah, right. Well, he's got 100 million plus net worth, so like I say, he doesn't need it. But as we know, ego drives people to do these things. But anyway, I don't know honestly. They know they're running out of runway in terms of the ability of the monetary system to handle the debt. And I'll give you a couple of data points on that. First is they at the last Fed meeting, they took the quantitative tightening, which is shrinking their balance sheet, reducing the money supply, or at least reducing reserves, which have the effect of reducing the money supply. They took that from 25 a month to 5. I thought that was interesting. They more recently have been talking about, some of the Fed governors were saying, well, we stand ready. When they saw the bond market back up from the low 3.38 to 4.4, so they very quickly went to Trump and said, sir, you got to put a 90-day wait on these tariffs. The bond market's falling apart. And so he did, and that got everybody calmed down. You also see, other little inklings of money printing coming. There's something James Lavish did a really nice job in his Informationist newsletter of laying out how the hedge funds are one of the largest buyers of the treasuries, and they do that because they do a basis trade, which is to say they sell a future treasury and buy a current one, and they can make a spread between the two as time goes by. And they lever that trade up very, very highly to give themselves a large profit if and when it works. The problem is that those spreads disappear or become disorderly in a very chaotic market, and the hedge funds can effectively find themselves quickly bankrupt unless they have access to new money. And so a Brookings Institute paper came out and said, we think that the Fed should give these hedge funds preemptive swap lines, which means preemptively we're going to print money to save these hedge funds. Kind of what they did with in 2020 and the COVID crisis, and also in 2008 when they bailed the banks out. And so, again, Kai, the book talks about this. The Fed really, at the end of the day, they have a lot of jawboning things they can do, but at the end of the day, the one big hammer they have is the money printer. And, if there's not enough money in the system, the debt keeps growing, they got to service the debt. Well, what do? You print more money to do it. And so that's what I see forthcoming, and that's why I named the book The Big Print. And I believe that big print is we're on the cusp of it. I don't know if it's in 2 days, 2 weeks, 2 months, but it's not 2 years. It's got to happen probably in the next 6 months.
The continued rise in gold prices points to a significant shift in the global financial landscape, driven by growing skepticism toward fiat currencies. As governments face mounting national debts, escalating inflation, and challenges in effectively managing their budgets, investors increasingly turn to gold as a stable store of value. The recent surge in gold's price reflects this shift, signaling a broader loss of confidence in the ability of governments to control their monetary systems. Central banks, acknowledging the risks associated with fiat currencies, are quietly increasing their gold reserves, further reinforcing gold's role as a hedge against the volatility of paper money. This trend accelerates as inflation erodes purchasing power and geopolitical instability rises, pushing the demand for hard assets like gold. The shift away from fiat currencies and toward assets such as gold and Bitcoin reflects a changing financial system where trust in traditional monetary policies is weakening. As confidence in fiat currencies diminishes, tangible assets immune to manipulation by central banks or governments increase appeal. That's it for today. Share your thoughts on Lepard's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.